equity and risk management. Now folks, this video is probably the most important video that you can watch with this, okay? This is the #1 reason why traders fail. 90% of all traders fail in Forex, and this is the reason why. And I see this all the time. I am a member of a lot of forums out there, including forexfactory.com, and I go on there and I see somebody say, listen, I'm buying the euro at 1.25, I'm in the euro at 2,500, and I'm sitting here nervous and praying to God that it works out. Man, if you are following the right equity and risk management protocol, you don't have to pray whether you're going to win or lose. You don't have to sit there nervously freaking out, because it's any numbers game. Listen, I want to get this out of your head right now. You're going to lose trades. Do you understand me? You're going to lose trades. And you're going to win trades. In fact, the reality is, if you understand property equity and risk management, you can actually lose more trades than you win and still come out very profitable. Now, how is that? Let me show you some numbers. 1 out of 10. Let's say we're taking 10 trades, and we have a risk to reward ratio of 1 to 2. That means if we were putting a 100 pip stop loss, then we are at least expecting the currency to move 200 pips in the positive, right? So if the trade goes against us, we lose 100 pips, but if the trade goes for us, we're up 200 pips, right? So our winners are bigger than our losers. Okay, if you have a trade that you're going to take that you expect the win-loss ratio to be 1 to 1, don't take the trade. Okay, if you're putting up a 100 pip stop loss and 100 pip potential profit, you're stuck in the middle. Either way you go, you're going to either lose 2% of your account balance or you're going to win 2% of your account balance. Your goal is, if you're going to lose, willing to risk 2% of your account balance, then you have a high probability of gaining 4%. Are you with me? If you follow that system right there, so that your win-loss ratio, your risk to reward ratio is 1 to 2. You understand? Then you could lose more trades than you win and still be profitable. Okay, a very wise man, Will Rogers, once said, now listen to this quote, this is very important. This is what he said. He said, I'm not as much concerned about my return on investment as I am my return of investment. Now, what does that mean? What that means is he's more interested in, like if you put in $1,000 into a trading account, your #1 concern is to make sure you still continue with that $1,000 down the road. Okay? Not to blow your account. I don't know if you've ever heard that saying before. If you've been trading for a while, you've probably heard it, and you may have done it. I've done it lots of times when I first started trading. Blow an account means, hey, I started with $1,000, $5,000, $10,000, and wiped out the entire account because I made stupid mistakes. No stop losses, managed too much, leveraged too much equity of my account balance on one trade, or 2 trades, or 3 trades, and my risk to reward ratio was off. Do you understand me? So our goal #1 is to be a player for the long haul. Okay? So here is the trade protocol that we're going to follow. And we are going to only leverage 2% maximum of our trade balance on one trade. That means if you have a $50,000 account, what's 2% of $50,000? It is $1,000. That means if the trade goes against you and hits your stop loss, you only lost 2% of your account, which is $1,000. Now, let me tell you, if you have $50,000 in an account and you lost $1,000, it's not going to emotionally wear you out. Okay? I'm telling you what, overcoming the emotional game is one of the biggest problems of understanding how to keep yourself solid and as a trader long term. But I'm telling you now, if you're risking 20% of your account balance, if you had $50,000 in your account and you lost 10 grand, whew, now you're in trouble. Now what you start doing is you start breaking out of being sensible as a trader, and you're going to do everything you can to try to, what we call revenge trade, and you're going to try to get that money back. Okay, you're gonna be overly risky. You're gonna make stupid, risky decisions that you shouldn't have made because you want to get that 10 grand back. That is why you don't risk too much of your account balance, because it puts you in a revenge trading mentality, which we need to stay out of. Now, underneath this video, there is a link to get Chris Lorry's Face the Trader Within. It's an ebook. You need to read that. It's going to talk about how to overcome the mental part of the game. I'm telling you right now, Forex is mostly mental. And we take that out. If you follow our trades, you don't have to worry about what trades to take. And if you follow this equity management guidelines and understand the mental game from the get-go by reading Face the Trader Within, you are geared up for massive success. So underneath this video, after you watch this video, you can click the download button, or whatever the button is underneath the video, and you can download that for free, okay? So we are only going to leverage 2% of our trade, of our account balance on one given trade. We want to let only, if we're in multiple trades, we don't really want to be in more than 5% of our total account balance. So if you've got a $50,000 trading account and you are in a whole bunch of trades, you don't want to be in more than leveraging 5% of your total account at once. So that would be $2,500. Okay, and that means if you're in 10 trades, you can't do 2% per trade, right? Because you'd be leveraging 20%. Now, what's the likelihood of all 10 of those trades going against you in one shot? Very unlikely. But you never know. Your goal is to survive for the long haul. Remember, it's a return of your investment, not on. Okay? And the next guideline is if you're in 3 or more trades, I would not trade more than 1.5% maximum of your account balance per trade. Okay, let's say you're in 3 trades. You might want to do 1.5%, 1.5%. And if you're ever in a Aussie yen trade, if I ever send you Aussie yen trades, those are the ones you want to hit 2% max, or whatever yours is. Now, you're responsible for yourself. Okay, you may want to leverage 0.5%. You may want to trade 5% of your account balance. That is up to you. But I'm telling you now, as a trader who's trades millions of dollars at a time, I never trade more than 1.5% of my account balance on one given trade, and never more than 5% collectively for all of my trades at once. So if I'm already in trades and I'm already leveraging 5% of my account balance between 5 or 6 different trades, and I see a killer trade come up, I don't take it. Period. I stay out of the market because I follow my equity management guideline. So let's show you some of these numbers, and then we'll get into the software and show you how to plug it in. So we talked about, let's say you have a $50,000 account, and you're going to leverage 2% of your account balance on one trade. Okay? That means you're only going to risk $1,000. If the trade goes against you, you're going to risk $1,000. And most of the time, we take these trades, the risk to reward ratio is, if the trade goes for us, we're actually going to make $2,000, so you make 4%. Okay? So in this instance, in fact, if you saw the video in the how to enter your trades, we actually canceled a trade at the euro US dollar at 1.52500. It had to stop at 1.24. We're actually going to end up using that as a demo purpose because it's nice round numbers, and we'll show you how to enter it and calculate how many lots you're going to trade, and how to enter the numbers and how to do the risk management all in one shot. Okay, so if we're buying the euro at 1.2500 and I tell you to put a stop at 1.2400, what is the pip difference spread between those? And you can calculate it. You take 1.2500 minus 1.2400, and the difference is 100 pips. Okay. So we are now going to spread that $1,000 that we're going to risk maximum across those 100 pips. So we take $1,000, we divide it by 100 pips, and the maximum we're willing to risk is $10 per pip. Okay. So in the software that we'll show you here in a second, one $10,000 lot equals $1 in my trading account. So, right? So I'm gonna trade 10 of those $10,000 lots. Are you with me? And hey, for those of you who want to get my winning trades sent directly to your inbox, and in 2011, we got 8,475 pips over a 12-month period. If you want to see how we can send you those trades directly to your inbox, go to the description below, and you'll see the information there, and you can go there and get registered for free. All right?